All right, let's bring in our jobs panel to react to the numbers. Natasha Sarin is professor at Yale Law School, president of the Budget Lab, and former Treasury official under President Biden. Peter Earle is the director of economics and senior research fellow at the American Institute for Economic Research. Sarah Malik is chief investment officer of Nuveen. And Sarah, I guess I'll just start with you. We'll get into the weeds on the numbers in a second. But as someone who needs to decide what to do with clients' money, this looks okay, doesn't it? Is there anything that you saw that disturbs you or would cause you to hesitate about deploying money?
I'm not surprised to see markets not reacting much to this number. Expectations were for a slight beat to payrolls with consensus at 65,000. So the number is a slight disappointment, but not enough to move the Fed. And that's what's important here. I think we can still get 2 rate cuts in the back half of this year. Also, this is the second number that is starting to show the true health of the labor market. Remember, September and October's numbers were very volatile. We had a negative 162,000 government payrolls drop in the October numbers. So we're finally getting clarity. And what we're seeing is labor markets are just normalizing at a healthy rate. And if we can continue on this path, and I think that we can, because government payrolls will have less of an impact on the negative side in 2026, then that tells us that the economy is fine. We have fourth quarter earnings season right in front of us with expectations of 8% year-over-year earnings growth. That's a sign of a healthy market, and I think we can hold our premium, and the markets can continue to rise up from here as long as earnings are strong and payrolls stay around this, 5-digit range.
And Natasha, so 50,000, a little bit light, and then a revision on the previous month. But we got AI. Maybe there's some factors for why that's happening. So that makes you worry a little bit. Maybe you're disappointed, but suddenly on 4.4, that it giveth and it taketh. That's better.
I think what you're seeing is you're definitely seeing signs that the labor market is continuing to cool, and that is the case with the 50,000 number. And importantly, this is the first number that we've gotten in recent months that isn't contaminated by the government shutdown and its aftermath. So I actually think it's an important read. But what you also know, and we also saw that in the JOLTS data that we saw earlier this week, is that we are continuing to be in this sort of like low hire, low fire economy. Right. And even with a relatively low unemployment rate, you aren't seeing hiring in the economy. And I think that has to do with the fact that there's just a lot of uncertainty right now. You're not exactly sure if you're a firm or if you're an employee, whether or not it makes sense to kind of take the leap because you're not sure whether jobs are going to be there to support you over the course of the choices that you might make.
And the Supreme Court might say something like in a couple of hours.
In 90 minutes, we might well see.
Even if we hear something, I mean, it's interesting to think about how the markets react. Even if the courts strike down the tariffs in their entirety,
right? You still don't know
what happens.
So,
do you think the market goes crazy? Doesn't go crazy? Do you think that companies all of a sudden are going to change their strategies all again? I'm not so sure.
Or will he find another way to?
Well, he says he's going to.
Yeah, I mean, importantly, the tariffs that are at stake in this case are about 2/3 of the tariffs that the administration has levied. Just this portion that's these IEEPA tariffs.
Right.
And so even if they're struck down, you've already seen the administration say kind of explicitly that they're looking into plans B with respect to other trade authorities that allow them to bring back tariffs to this level. By the way, I'm imagining if the Supreme Court strikes them down at 10 o'clock, that there's a press conference at 11 o'clock from the White House saying, just so you understand, we are now implementing these tariffs this way, this way, this way, and this way. But I feel like that matters from the perspective of economic uncertainty because the effective tariff rate has changed some 80 times so far in this administration on different days. So what you're going to see is they're going to use this authority for this particular type of tariff to replicate this authority for this tariff. And it's actually not going to be this sort of cohesive, all of a sudden we're back exactly where we were previously in a way that I think is pretty uncertain and kind of tenuous from an economic perspective.
Peter, you're so patient. Waiting so patiently. Do you want to? You can just give us a 10-point summary of everything everyone said.
Sure. So 2 things. I mean, I think that the non-farm payrolls number reinforces the story that's been building for months. Right, a labor market that's slowing, but in a pretty deliberate way. Firms are holding on to workers. They're no longer expanding payrolls aggressively. And that combination is, I think, exactly what the Fed wants to see. Fewer openings, restrained hiring, stable employment. About tariffs, What I think is that there's a plan B already in effect, and if the IEEPA, if the IEEPA tariffs get struck down, we'll see a replacement with quotas and all sorts of other means of protectionism which meet the definition, but not the letter, or the spirit, but not the letter of the law. So that's what I think. I think there's a backup plan in place that we'll see put in place, almost immediately.
Yeah. The P word. People don't usually use the P, but that's what it is, isn't it? Simply put, protectionism.
I'm just calling it what it is. I mean,
no, I hear you. Rick, are you still with us?
Absolutely. I'm here. What do you need, Joe?
I just, the Sohn rule or whatever, I just feel better because we're not a half a point above the lows. So we're not headed to any...
what? You read my mind. Yeah, the Sohn rule doesn't come into effect now because 4.6 disappeared. So, yes, that's interesting. The other thing, and it's not directly based on this report, I'd like to know what our group thinks about the $200 billion talked about purchase in mortgage securities, because when I heard about that, I monitored the markets, I monitored all the different coupons, and as an ex-trader, what I thought was that just saying that would elicit some buying response from investors. But I haven't seen any. The market's hardly moved at all. I was a bit surprised. I thought maybe the group might want to weigh in on that.
If I can jump in really quick, Rick, I just want to say that these are all demand side issues. None of this is bringing new houses into the market, which is what we need. 50-year mortgages, replaceable mortgages, all these things. None of this brings more houses into the market. And that is the crucial thing right now. I've said my piece.
No, you're absolutely right. But. Okay, we can't invent a time machine and build houses any faster, so you're correct. However, it's nice to see this administration trying to throw some spaghetti against the wall and see what sticks. There may be issues here because the road to try to lower mortgage rates via bringing long-term rates down, that road, in my opinion, is closed. So they have to try to find alternatives, and I at least give them credit for trying.
Sure.
I kind of think it does feel like spaghetti against a wall, Rick, in the perspective of who even knows what his plan is, who even knows his representatives are supposed to be sort of spending $200 billion. I'm not really sure what to make of it, but I do think that I can understand why, particularly in an election year, you'd like to see interest rates come down. I just don't particularly think that this is the approach that's going to be all that successful.
Hey, Sarah, while we have you here, we keep talking about it. I'm no longer saying Happy New Year, but we don't have your 2026 guidance for where you think equities are headed. So the multiple might be rich, but earnings could I don't know what you think. Is it double digits? We heard people say high double digits for earnings growth. If the multiple stays where it is or just contracts a little, doesn't it mean we could have another good year in equities? Or is there something on the horizon that makes you think not?
We always have to worry about the horizon and what may cause volatility. And I think that could be geopolitical issues, which have already been bubbling up earlier this year. But you're right, Joe. Even though markets are at a premium, earnings expectations for the year are coming in at about 15%. Let's give a haircut to that and say earnings grow 10%. That's positive for the markets. Our price target for this year is 7,500 on the S&P 500 because we think earnings can grow in the high single digits to low double digits. We'll see that kicking off with fourth quarter earnings season, basically right now. And what I think will lead will be technology and financial. So financial stocks should have a very strong earnings season. They kick it off, less regulations, a better M&A and capital markets, and also technology stocks where if we like earnings growth of double digits for the S&P 500, tech stocks should be double that, and that's why they should continue to lead. So I don't think tech is in a bubble. I think tech can continue to lead the markets this year.
And Peter, you're a director of economics, senior research fellow. How much stimulus do we have coming this year from wherever you want to look for, whether it's deregulation or expensing or the big beautiful bill? We all miss the days of the pandemic after that. Now that was stimulus, but maybe that wasn't so great. Right. But don't we have some maybe a better type of stimulus on the way?
I see three major sources of it, right? The first is, of course, the big beautiful bill and all those tax breaks that are coming. The second is there's still some whatever you think about it, there's still some Biden era spending going on in the economy, which is promoting construction, that sort of thing, and semiconductor fabrication plants, that sort of thing. And the last is, of course, the Fed is accommodating now, and they recently added the balance sheet to that to the mix in what is essentially QE light. So, that's a lot of things, pushing. There's a lot of tailwinds to the economy right now. And I think that these forecasts are pretty accurate with respect to earnings and all that.